climb, and this is where you should be invested, and more importantly, where you should not be invested. David Barse, founder and CEO of XOUT Capital, joins us today. David, it's a pleasure to have you on the show. Welcome.
David, it's a pleasure for me to be here. Thank you very much for having me.
Offline, you were telling me that risks to the equities markets are skewed to the upside. Can you elaborate?
Look, I think the market is going through an interesting time now where you have outside influences like the Federal Reserve pumping up the market, and you have the inability to allocate to any other asset class. And I look at fixed income, cash, and equities as the three asset classes to allocate to. As you know, our colleagues at Granite Shares also have a gold ETF. Gold I put in a separate category, but clearly there's nowhere else to go but equities. And so I look at the marketplace optimistically and continue to believe that equities are the place to allocate capital.
What would you say to market bears who claim that the economic recovery is sluggish at best, that we're going to continue to see weakness in data and growth, and that valuations right now do not at all reflect economic reality and should be much, much lower?
I'd say those folks are really smart and probably really right, but they're only right about the companies and the industries that are suffering as a result of what's going on in the marketplace. And again, this goes to the fundamental premise of XOUT. It's more important what you leave out of your portfolio than what you put in. So to make a generalized statement about the market without impacting the losers versus the winners, the haves versus the have-nots, and we're only focused on the have-nots. And so they're right, I agree with them, but not in a broad, all-encompassing way.
We're going to get to XOUT and your strategies in just a bit. But first, I'd like to know your take on the elections coming up. How do you think results either way would influence the markets?
Yeah, if there was an amendment to my answer from the last question about the optimism of the future, I do think that the election, which is an unknown, could have an impact negatively on the markets. Clearly, no one has an idea about what's going to happen. There are all the pundits out there making speculative calls about who's going to win, who's going to lose. But there are scenarios where the Republicans can lose the Senate in addition to the presidency. And that, I think, will have a very negative impact on the marketplace, especially if regulatory reform gets underway in a short period of time as a result of control of both houses of Congress. And so I would be less optimistic in that scenario. I can't predict what the election is going to do, so I'm an optimist today because today we know what the situation is in terms of who controls the Senate and who's the president.
What kind of reform are you talking about that would bring down stocks?
Tax reform in particular would be the dominant one, but obviously reinstituting many of the regulatory oversights that challenge businesses, make businesses and acquisitions and all kinds of growth opportunities for businesses more of a challenge could come back and make it a difficult environment.
You don't think that the markets have already priced in these risks? How do you feel about valuations, generally speaking?
No, I don't think the market is priced in this risk because the market is smart enough to know what it doesn't know, and it hopefully learned a valuable lesson from 2016, where I think, as I understand, some of the evaluators we're about in the same place we were then in terms of the prediction of the election. So not likely to make one-sided bets either way. But I don't think valuations are exceedingly high because I don't think fundamental metrics for traditional valuation methodologies are applicable to what's going on in the world right now. I think technological disruption is impacting all companies, all industries, and using traditional valuation metrics as a way to determine whether the market is overvalued or undervalued is just not appropriate anymore.
So all these indicators like PE, EV, EBITDA, they don't actually tell you anything about the future. Is that what you're saying?
Yeah, I mean, think about, as a former value investor, price to book was one of the most significant measurements we used. And if you look at some of the value companies that are trading at discounts from book value, there's probably a pretty good reason for why that's the case and why it's likely to continue to be the case for the long term.
What are the risks are you looking for? Is COVID still a concern for you or not anymore?
Clearly, the pandemic and the coronavirus are still very active risks, and that's mostly because we just don't know. We don't know how a vaccine is going to get developed or when it's going to get developed. We know there are all kinds of treatment protocols that have been put in place that made it better than it was in the fall, in the spring, and early late winter. But we don't have enough answers today to know that there's not going to be a resurgence, that there's not going to be a COVID-20. So there's so many things out there that are unknown, and many scientists who are pontificating about this have different opinions, and I think that's part of the problem. I'm a post-COVID symptom. I had COVID symptoms, and people can't tell me today whether my antibodies are going to last for 3 months, 6 months, or forever. Nobody knows.
And you said that gold is a separate asset class. How do you feel about gold? You wouldn't use it to hedge your bets here?
As I said, I look at gold as a storehouse of value for those who have an uncertain view of the future and want an opportunity to be able to allocate some component of their capital to gold. But it's different in my perspective from cash, from fixed income, and from equities. And so those who use gold use it for whatever their reasons might be, but I don't look at it as part of a traditional asset allocation model.
You don't think a vaccine is going to be impactful for the equities markets at all?
I think once a vaccine gets adopted, and there are likely to be more than one vaccine that's going to get adopted, you're going to have execution risk that's going to go into making sure that everyone in our country and in other countries actually take the vaccine. I don't think it's an ordained statement that once the vaccine exists, this whole problem goes away overnight. It's going to take a lot of time for that to get implemented and executed.
Okay, let's talk about the XOUT index now. You have a very unique approach to investing. Instead of picking the best performers, you're just picking out the worst performers or the laggards, if you will, and just excluding them from your portfolio. So the XOUT index, you were telling me, has outperformed the benchmark S&P 500 by 12%. Is that correct?
Since our index was launched in July of 2019, yes.
So what's in this XOUT index? Can you give me the names?
So again, we're focused on what to exclude.
Yeah.
More important, what you leave out than what you leave in. Currently, after our last rebalance, we've left out companies like JP Morgan, Exxon, Chevron, AT&T, and Verizon, to name a few large cap companies, the largest market cap companies that have been excluded. And in each case, those companies have scored poorly on our 7-factor model that we use to identify how to, if you will, eliminate the bottom 250 of the 500 U.S. large cap market cap companies.
Well, one of the things that I've seen you list on your website about your criteria is companies not having a growing workforce. Why is that an important indicator of strong growth for you?
Well, this is an interesting question because arguably if technology is succeeding, it should have an opportunity to decrease labor expense, since that's a large expense for most companies.
Yeah.
But in the case of where we look at the largest 500 companies today, if they're hiring people, they're likely to be growing businesses. And growing businesses are usually succeeding in environments of disruption. Businesses that are not growing are obviously having challenges, and they're reducing their labor force. So we can think about what has happened most recently to the retailing industry and how those are obviously companies that are decreasing staff right now, not increasing staff, as an example of something that's triggering that negative score.
Do you think that companies will, in the stay-at-home work culture that we're living in now, that many analysts think is going to persist for a while, do you think companies in this environment are going to save on, let's say, rental costs, which is going to bring down the fixed costs, and instead just hire more people because they could? Would that happen? Yeah,
I mean, eventually things have to rationalize. If we're going to evolve into a new paradigm of how one comes to work in the future, that they aren't necessarily coming there, they're virtually coming there, then businesses are going to have to make a decision about how to reduce what, in many companies' cases, is a significant expense on their income statement. So if they can reduce rental expense, you could see that happen. And I think you've already seen that in some announcements of companies downsizing office space or reevaluating what they need.
Yeah. Last time I spoke to Granite Shares about the XOUT index, I actually showed one of my friends who's an investor the interview, and he asked me this question that I didn't have an answer to. He said, well, I have a list of the companies that he X out. What should I do with that? Is that just to exclude, or should I short it? I mean, there's a very big difference to exclude and to short it, right? So can you clarify the difference here? What should he be doing?
Yeah. I mean, that's a great question. I would tell you that in a certain respect, what we're doing at XOUT is a scaled short selling methodology. But I would make the argument that short selling is a really challenging thing to do. There are very few asset managers out there in the marketplace that are managing large pools of capital with just a short selling methodology, right? I think there's only one fund, to my knowledge, that's over $1 billion in assets under management. And so if you're successful at short selling, you have to not just identify those individual companies that might become losers. You have to time it perfectly. You have negative tax implications, even if you're right. And you could hold on to that short for a long time, and you're still going to have a short-term capital gain treatment. And there's expensive costs associated with borrowing if you're going to short that company. So for us, simply excluding them, just don't own them. Just not own Exxon, and look what kind of contribution you can make to a broad-based portfolio of U.S. large cap companies. Yeah. It's too easy. That's my frustration. What I'm telling you and your viewers is so easy that people scratch their heads and say, it can't be that easy. Yes, it can.
I think a lot of people would say, hey, if it comes too easily, there's probably a catch. And so that's where the hesitation comes in. So there's no catch, you're saying. Just don't own it, you're going to outperform.
Open our myth then, David, and figure out if we can catch something, because I'm still scratching my head saying, why are we the only ones doing this?
That's an excellent question. And do you have an answer as to why no one else has picked up on the strategy?
I think because I'm one of those guys who came from outside the ETF space. Yeah. I was in a traditional long-only fundamental asset management firm for 25 years. Yeah. And that's part of what's taught me how to do what we're doing. And maybe those inside the industry, they're always trying to identify the next winners. They're coming up with a factor-based strategy that's going to beat the market, or a smart beta strategy that's going to beat the market, or some select fund that's going to identify the sector that's going to beat the market. And I say, boy, this is so much easier what we're doing. Just take that broad index where all the flows are going. I like to say that we're like, Wayne Gretzky's that famous quote, we're like that hockey puck. Where that hockey puck is going, he always was there before that hockey puck got there. Mm-hmm. And that's what we think XOUT is. We're trying to anticipate something in the future, and we're trying to get there before everybody else.
One of the stocks that you've X'd out is Coca-Cola. I bring this up because Coke is Berkshire Hathaway would consider a value stock. Warren Buffett's owned this for decades, and I think it's still one of his top holdings. And you don't like it because it doesn't meet the criteria of the growth metrics that you've discussed before. So, why are old school value investors still holding on to this, do you think?
I think one of the things I've learned from entering the ETF marketplace is you are generally a rules-based strategy, and you don't allow personal biases to impact your decision-making. I think for active managers, there's a personal bias, and they hold Coke because they love Coke. Warren Buffett used to make jokes all the time. I love drinking Coke. He'd always carry a can of Coke with him wherever he went to promote his investment thesis. I'm not sure that just the taste of it was really the reason. But think about Coca-Cola just today. It's failing on our scores, and that's why it's being excluded. But just take the logic of that to its next extension. And the restaurant industry, which we know has been decimated in our country as a result of the pandemic, was a big vendor of Coca-Cola, right? They supplied Coca-Cola. Many restaurants served it. It was readily available. I think a lot of people would want Coke over Pepsi, and they'd go to restaurants that had Coke over Pepsi. Uh-huh. Well, that is something that's obviously impacting its current growth rate. And so it's just not scoring well. But if I let myself be an active manager and try to apply a bias that the stock's just getting cheaper, and relatively speaking to the other companies in the large cap index, I want to own Coke because it's cheaper. We don't allow that personal bias to override our decisions.
When I'm looking at your list now, I think a common theme is recurring in my mind. These companies that you don't like seem to lag behind in technological innovation. Is that a correct statement to make?
Yeah, I mean, we could have a long debate about a company like AT&T that's trying to do and Verizon that's trying to do everything they can to take advantage of the advancements in 5G, for instance, and what that's likely to mean for the future. But that investment is going to take a little while to translate into revenue growth.
Yeah.
But that is right. What we're looking at and what we're thinking about is how technology disruption can or will impact companies. And we use historical financial information to create the score that will make a judgment on what is likely to happen in the future. But that risk of technological disruption, it's not unique to just communication companies. It impacts all companies throughout every industry sector in the largest 500 market cap companies. Yeah. So you got to be thinking about that risk. I think it's the most significant risk because we don't think interest rates are likely to rise in the near term. We've already learned what our Federal Reserve is going to do about that. So what's your biggest risk as you look out in the future? Maybe that and the election?
If I were to argue that, look, you don't need a company to have revenue growth. You don't need a company to be an outperformer in the tech space or have a lot of R&D on their income statement. You don't need a company to continuously outperform analyst expectations. In fact, those companies that don't do any of those things are probably beaten down so cheaply that it's probably a good value to buy them. Well, how would you respond to that?
Yeah, I'd say value trap. You just defined a value trap, didn't you? I mean, I view, again, from my past, from my experience, the reasons that those types of fundamental screens would identify a value company as opposed to identifying a company that's possibly likely to be disrupted become personal bias decisions, because you have to continue to believe that your research is correct and that somehow some event's going to occur that's going to recognize the value that you see and that the market doesn't. There's only two ways for that to happen. One is somehow the stock market makes a reflection decision and the stock starts to rise. If that hasn't happened for some significant period of time historically, that's likely not going to happen. And the second thing that could happen is you've got M&A activity. You might have a strategic acquisition where someone looks at the value of the company and says, boy, this is super cheap. I'm going to buy it because I can get it at a much cheaper valuation than what I think it's worth. And so for strategic acquisitions, I could see that happening. But how much of a material gain are you going to obtain from strategic acquisitions? We've seen some of them getting done in the market, and you see the valuation. They end up picking prices that are off, maybe premiums to current market prices, but not that significantly off market lows. And so even strategic acquisitions as a exit strategy for a value decision is going to be a challenge.
All right, so we've talked about what you don't like. Let's talk about some of the stocks that you do like, that you hold.
Yeah, so look, we're obviously technology heavy.
Yeah.
Those are the stocks that score the best in our screen, but we don't pay that much attention to those so-called stocks in the portfolio. Mm-hmm. That's the beauty of our strategy. Our strategy is really flipping the investment paradigm. From the day I started working in financial service industry, everywhere I went, whoever my mentor or teacher was, all they taught me about was work really hard, do your research, and identify winners, pick winners. And here, we're flipping that entire investment paradigm. It was a challenge for me to figure out how to throw away 30 years of education on the job. But that's effectively what we've done here. I can talk to you all day long about why we're excluding something, but I'm not going to let the winners dominate our conversation because they're just happening naturally. We're just focusing on the losers and not on what the consequence of the portfolio may be as a result of what we exclude.
You don't think there's a tech bubble right now?
I don't at all. If you think about some of what has been reported by some of these companies, some of the mega techs in the S&P 500 in the large cap universe, it's been phenomenal what they've been able to achieve. And that bifurcation in the market isn't just an unnatural phenomena. It's happening for a reason. And when companies can continue to produce cash flow and growth and earnings the way that they have, and create that separation, and then have the ability to make investments in their business in the future, or even borrow money. We've seen what some of the megatechs have done out into the market and what they can borrow money for. It's incredible what's going on right now. And that bifurcation is what XOUT sought to exploit. I just didn't know when we launched that the disruption event was going to be a global pandemic. I knew that there would be disruption, and I knew that Moore's law was going to continue to allow things to speed up, but I didn't know that a pandemic was going to be a catalyst for an accelerant. And I'll tell you something else I don't know. I don't know what the next disruption event is going to be, but there's going to be one. I can't predict what it will be, but it will continue to further divide those that are being disrupted and those that are successfully addressing these kinds of accelerants.
Last question, David. You used to be an active fund manager and are no more. Why did you make that decision to switch?
David, that's it's a sore subject for me. It's a sad story. I think I was in my offices when Lehman Brothers filed bankruptcy, and I remember seeing the impact to our portfolio at that time, and calling up investors and explaining to them how cheap our portfolio had become as a result of these events. And every day, with the